is up, Zinger Nation? Welcome back to another episode of Benzinga Live. Happy Tuesday, everybody. What is up, everybody? Happy Tuesday. Welcome back to another episode of Benzinga Live. Shout out to everyone who tuned in to pre-market prep this morning. Of course, was filling in for Mitch there. So good to be back here on Benzinga Live, where it's more what I'm used to. But we're gonna be bringing on my man Ryan Pannell for another exciting edition of our educational series with Kaiju. Of course, we've been doing this pretty much every Tuesday for the past couple months now, and every week we are discussing different things in the market and learning from Ryan, who has extensive experience as a professional trader and now running Kaiju, which is using a lot of cool different AI technologies to run its ETFs and do some really cool, exciting things. And it's just been a blessing to have Ryan join the show and share some of his expertise. So with that, let's go ahead and bring my man Ryan on, because it's been a couple weeks. I'm excited to see what he's got in store for us today. My man Ryan, how are we doing today?
Good. You say all the nice things before these shows starts. I love it. I feel like I should tell my mom to watch or something like that. Look, this guy says nice things about me. It's
all true. I mean, look, I'm like a guy who just started trading stocks during COVID-3. Like I have no business even having these conversations with you. I feel very lucky that you're.
Come on, anybody can have these conversations. It's not a closed club, right? That's what we're doing here. I want to treat it like a bit of open information for everybody.
And that's really what Benzinga is all about. Benzinga is, part of our mission is always to try and to democratize financial news and data, kind of take things that have been these trade ideas and this information that had been kind of reserved for like the elite of Wall Street for a long time, and make sure that everyday people, like myself, like the people in the audience, have this type of information. They can make more informed decisions with their trading and with their investments.
Yeah, exactly. I mean, and there's stuff that's going to be impossible to share in this kind of a forum, right? Like, no matter whether you had access to a top trade desk or not, someone comes in and says, hey, give me some tips. I want to learn how to trade, volatility arbitrage and options. Like, forget it. That's never going to happen. Not on a retail level, not ever. Like junior traders spend like 3 years before they're placing trades in that type of a trading environment. But long, short, equities, basic options. Yeah, there's a lot of accessible, easy information that you should be able to get from professionals. They just tend to not share it. So that's what we're trying to change. As usual, share some information.
A little secret.
Not going to kill us, right?
Yeah. Well, Ryan, I had mentioned it's been now a couple weeks since we've been together. Can we just give a quick recap of kind of where we left off, what we discussed, I guess a couple weeks ago now?
Yeah, I think, we ended on a fun one, right? We went through some indicators that you might want to use for swing trading and position trading, how to set them up, how to read them. And we went through a couple of examples of, sort of, and I hate to say it's not red light, green light, it's not go and stop, but it's conditions that are favorable to placing a trade in that environment, conditions that are not favorable, and how the indicators can help you see that a little easier. And they're complementary to the other work that you do as a trader. So that's always a fun one. People are, like we said on the show, they're convinced that the indicator is going to make all the difference. They'll make a huge difference, but they won't instantly make you money. There's no collection of indicators that you can just follow the patterns of, crosses or whatnot, and be a successful trader. They don't work that way, but they hopefully can help you see opportunity that you wouldn't see otherwise, and see risk that you wouldn't see otherwise. So that was fun. Today, not so much fun, because this is all risk management, which is mostly about saying no. But honestly, this is where you make the money.
Right. The risk management is kind of like it's kind of like dieting, right? Like who wants to be told no, you can't eat that cookie after dinner, or no, you have to be disciplined
Well,
and
it's like it's the downside of that, health and wellness. Like, how do I get six pack abs? Yeah, you got to go to the gym. You got to not drink. You've got to eat like this, and you've got to do that for a year. Like nobody wants to hear that. Everybody wants to hear the 10-minute abs, right? It's like all I got to do is no. You got to do that, and then all
yeah,
this
give
other
me give
stuff.
me give me the
Yeah,
10-minute abs and a stock that's going to go up 1,000% overnight
yeah,
that I can just
exactly.
get rich on real quick.
Exactly.
And then we'll be
Nobody
good.
wants to do the risk management part, but that's honestly, you'll hear from every professional trader will say the same thing, and that's that it's relatively easy to make money. The hard part is keeping it. And probably most of your viewers have experience with that. They'll go on like hot runs and you're planning out how this is going to replace your job if you're doing it for sort of secondary income, and you're projecting this out 10 years, and then you get smoked 1 week or 1 month and you're back to close to where you started again. And that's really down to what we're going to talk about today.
Well, let's get into it, Ryan. Again, today's topic, it's all going to be about risk management, how to minimize your losses. If you guys have any questions on this topic that we don't get to, let us know in the chat, and I'm sure we can discuss them. Um, so, part of being a successful trader is having a plan of attack, doing things kind of with strategy, not just, throwing things out there kind of willy nilly. Why to you is having a comprehensive strategy so important?
Well, if you don't have a plan, then let's be clear, you're just gambling, right? And I mean, hey, if this is the way in which you want to gamble and you do it responsibly, I'd rather you're here than out at the track, to be perfectly honest. So if that's your thing, like you used to bet on sports and now you play the stock market a bit, have fun, more power to you. You don't need this. But of course, if you're doing that, you're accepting, potential 100% loss all the time. That's not really what we're focused on. We're focused on people who are trying to do this to add a secondary income, to self-manage their investment portfolio, to perhaps they're hoping to treat it as a primary source of revenue. This is going to be your future. You're going to be staying home. You're going to trade a portfolio. And if that's the direction that you're going in, then having a plan is essential. Like no professional trader is like just running random scans, seeing some vol buzz output, being like, oh yeah, that's running today. I think I'll pick up some of that. Nobody does that ever. Like not ever. For one, we have to be able to explain every single trade to the regulator. So if I literally gamble and I'm just super lucky, I buy this stock, I'm like blindfold, I'm bored, I buy 250 grand of this thing, and all of a sudden there's some announcement that comes out and this thing goes 10x in 2 days, I am going to have the SEC at my doorstep asking about that trade. And I can say, dude, it was totally random. I literally threw darts at a board and I picked that. But as a professional market participant, I'm probably going to be in a lot of trouble. So everybody has to be able to explain the rationale behind their trade decisions. And that should flow through to the retail side. If you don't know why you're buying something, or shorting something, if you haven't planned this out, you should not be doing it. That's like right there. Stop what you're doing. Like you should have done some sort of analysis. You've got a plan. This has ticked the boxes for you on some level. And then you've done this run gain analysis right? You've done your return on risk evaluation to determine if it doesn't go well, what's going to happen to you? What are you prepared to take in terms of a loss? If the answer is nothing or very little or an unrealistic amount, stop what you're doing, walk away. You don't actually really want to make this trade.
Yeah, and I mean, it's I think that's where a lot of people that are newer can sometimes run into problems is maybe they have some initial success early on and then they want to keep going even if maybe the market's not set up for it that day or they have trades that aren't working out and they're like, "But wait, hold on, I made a grand last week. Now I'm down 300. I got to make 13 more hundred to get back to make another grand this week." And then they try to kind of force it. And at least in my experience, when I've tried to do that, it doesn't really work out that well. Some other people might have some other experiences, but maybe not. Um, Ryan, for you, how does risk mitigation fit into a comprehensive strategy?
It's after you've identified the opportunity, it's the next phase of the opportunity. So if you're running any kind of software that's allowing you to scan for specific opportunities, whatever it is that you trade on, you're a momentum trader, you're a position trader, you're looking for consolidations within a platform, you're looking for, I don't know, old school breakout patterns, whatever it is you do, your life will be infinitely easier if you use software that allows you to scan for this condition, right? So you're running these things every day. And maybe there are scans you run in specific market conditions and you don't run in others. And so you're running your scans, right? And this is kicking out candidates to you. You're scrolling through these candidates, spacebar tab, whatever it is, and you're landing on something that ticks all the boxes because it's programmed into the scan. So now you're going to do a deeper analysis. If you're a fundamentalist, you're reading some quarter on quarter. If you're a technical trader, you're looking for specific confirmation signals in the indicators. And after you've seen all of that, you have to do this, risk analysis. It's like, okay, where do you need this to go relative to where you're going to tap out for this to be worth it for you? And if you are, everything's green light go, but you are at an all-time high and a run exhaustion pattern, and it is a long way down before you tap out, are you honestly expecting 2 to 3 times that on the upside? Probably not. And if the answer is no, that's unrealistic, and I don't think it'll get where I need it to go, you need to move on to the another opportunity. So it's the step that comes right before I'm going to load this into my order ticket entry window, right? Is your risk assessment.
Yeah, and that's again, like what you're willing to risk, I think is the one of the most important questions you have to ask yourself as you're starting out and trading. Because if I always tell people, right, to not trade with whatever they can, right? If don't start trading and buying stocks with money that you need for rent or something. But if you have, okay, here's $500 I have on the side. I don't care if I lose all of this, then okay, that can help determine how you can invest this and how much risk you can take on. If you have a pile of money and you say, okay, I'm willing to lose 20% of this, but not all of it, then that's going to impact like what risk you're willing to take on and where you might be able to trade. And because I think there are a lot of ways you can still take some risk on and still make money without necessarily putting everything you have at stake versus if I go buy a bunch of options that expire tomorrow, I'm putting it all at risk. And I know if I ever do that, which I do that sometimes, is I'll buy, some SPY calls or SPY puts that expire tomorrow. But I treat it like you said, or like you were talking about, like sports gambling. Like I would treat that as something like, hey, I'm going to spend $200 on these calls, knowing full well that not only is it a full possibility that I lose that whole 200, it's probably more likely going to happen than not, right? Like the way those options markets are set up is they're not meant to be, over 50% hit rates on some, or at least some of the ones I'm doing, but they're meant to be kind of like, oh, in this, in the minute chance that the market goes up 1.5% tomorrow, I'm going to make a lot of money off of this versus, okay, I was okay losing that $150 or 200 because I had my thesis and it didn't play out or whatever it was.
Yeah, exactly. And you have to let the law of large numbers work for you. Like that's what any professional trader does. If you flip a coin 10 times, it's totally possible that you'll get 10 heads and 1 tails. But if you flip the same coin 20,000 times, you're going to get almost dead on 50-50 because that's a coin flip. But you have to let the law of large numbers play out to do that. So if you've got your hypothetical example of I've got $500 to trade, if you throw that into one trade, like you need it to win. If you lose, depending on how much you've bet, now you got $400. Now you've got $300, whatever it is. I mean, small size is your key and more options, right? If your scans, if by the time you are done your analysis, you turn up 10 candidates that in your opinion are equally valid and equally likely to achieve success, your outcomes are going to be vastly more favorable if you can trade all 10 of them. if you can only trade 5 or you only pick 5, it's possible you've picked the 5 losers. And the other 5 are total winners. So smaller, more, better, for sure.
Yeah, so I agree with that 100%. Ryan, what is asymmetrical return on risk, and why is it important to you as an investor and trader?
If everybody here takes one thing away from anything that I say over like these 8 episodes that we're doing, like this is the one thing that you should take away. And that's the power of asymmetrical return on risk. This is how professional traders make money. If you want to know how we make money, this is how we make money, right? It's not some trick, it's not some club, it's not inside information. It's that we leverage asymmetrical return on risk. And most retail traders do not leverage asymmetrical return on risk. So what that means is that we make more money when we win than we lose. So you want something that's very minimum, like you take $1, right? Any trade, you win $2, you lose $1. Preferably it's 3-to-1 or higher. So when you win $3, you lose $1. Almost all retail traders trade with an inverse asymmetrical return on risk profile. And, in doing research for these segments and for what I was going to share, I would lurk around in some retail trade rooms just to see how retail traders were talking to each other. And the thing that I saw over and over again were people posting, right? Common rule in a retail chat room is you're not allowed to post an exit unless you've posted an entry. So you have these people posting their entries, right? And they would say, just bought 100 lot XYZ at $10, looking for 50 cents of upside, willing to tolerate $1.50 of downside. Don't chase if you can't take the pressure. And that blows my mind. It's like right there, you're chasing $1 on the upside. You're willing to lose $3 on the downside. So you got to beat an 80% win rate to kind of sort of break even on your trading strategy. And that's the thing, right? Like everyone focuses retail on win rate, right? It's like, how often are you right? That doesn't matter at all. It's the asymmetrical return on risk. Ray Dalio, on average, like their Bridgewater looks for a 5-to-1 asymmetrical return on risk. He can be wrong like 7, 8 out of 10 times and still make money. Like, just let that sink in for a second, right? Instead of having to be right 75% of the time, 80% of the time, you could be right 30% of the time and make money if you have the right asymmetrical return on risk. So every time you do your analysis, you need to get $2 to $3 of upside per dollar of downside that you have at risk. That is the difference right there.
And I think that's just a super important point to bring up because, like you said, with some of these trades that people are making in the chat rooms and whatnot, you have to win like an extraordinary percentage to be making money, which is just, I'm not going to say impossible, but pretty much impossible, right? Like no one's winning 80% of their trades, even people that are really good at it. Like you said, they just have the professionals have better risk management and are winning more than they're risking, so that you don't need to have an 80% win rate to be positive at the end of the month. So
exactly. And you think about a couple of the big icons, right? So Paul Tudor Jones, iconic trader, iconic fund manager. He has, at the peak of his career, he was right 6 in 10 times, which was considered relatively extraordinary. 6 out of 10 times. That's it. Renaissance Technologies, the top performing hedge fund on the planet for the last 30 years, is right a little over 50% of the time. Okay, so how is it that they have a 67% return net of all fees every single year on average for 30 years? Because they have a ridiculous asymmetrical return on risk. So when they're right, they win a ton of money, and when they're wrong, they lose very little. So that's the key. Like, instead of trying to be right all the time and then wearing that on your shirt, right? Like sitting there and being like, oh man, I was wrong again. Leverage it to your benefit to have a properly skewed asymmetrical return on risk. And then you don't have to worry about being right so often, because when you get paid a lot more.
yeah, I mean the Renaissance story, if people haven't gone out there and learned about that story and Jim Simons and everyone over there. I mean, it's just incredible. I mean, you could learn a lot from just what they do, I think. And can't I mean, it's just tough, I think, that people don't grasp. It's hard to grasp your head around that, Ryan, that just over 50% win rate, and yet you said the returns were what? Over 60% on average? I mean, it's insane.
67% net of all fees after fees. And bear in mind, Rentec charges a 45% performance fee and a 4.5% management fee. Like, post 08 collapse, they lost like, I don't know, 40% in 2 weeks. And then they ended the year 126%. Like, yeah, fine. So they're an AI shop and the godfathers of AI quant originally, and then AI and investment management. But still, like, what did they do? Did they build systems that won all the time? No. They built systems that delivered high asymmetrical return on risk and simply won better than 50-50, like barely better than 50-50.
Yeah, and again, I mean, like, we're, as retail traders, we're not going to be able to do everything that Renaissance does. I'm not saying that because they're obviously doing these, crazy quant trades and using AI and all this stuff. But can you learn a thing or two from like their
it
overall?
tells you what they focused on, right? Like, if they focused on, if what snuck out of that shop wasn't that their win rate is slightly better than 50-50, but their win rate was above 80%, you would know where to focus your efforts. Well, I guess I got to get more accurate. I guess I have to try to pick strategies that, where I win more, but that's not where they focused. So why should you focus in the same areas? Why are you going to beat yourself up trying to be 6 out of 10, 7 out of 10, 8 out of 10, when you can be 3 out of 10 or 4 out of 10 and still make money? I mean, you have an inverted asymmetrical return on risk. And with the cost of trading plus your time, if you're trading 1 to 3, you can be right 75 to 80% of the time, and you will lose money. At the end of the year, you'll be looking at it going, I don't understand. I win most of the time, and why am I down? Why am I down small? Because you trade 1 to 3 and not 3 to 1. And when that pops up, so why are you doing that? Because you're not actually comfortable with the risk of the trade. Like, you're doing your analysis, you look at the chart, and you set your stop loss. If you're not using a stop loss, that's insane. Every single equity trade should have a stop loss, just as a mechanism to check yourself. If you are not willing to put a stop loss on that, you're not actually comfortable with the risk. If you're comfortable with the risk, why do you care about putting a stop loss on? You're trading something at $10 and you don't want to put a stop loss at $9 and you think this thing might make it to 13. Where would you be comfortable putting the stop loss? $8, $7.50. Okay, so now your return on risk sucks, and you know that you're not really comfortable with the level of risk in that trade. You would have to assume, like, either you're going to get stopped out too early, okay, it needs to go further, or you need to pick something else, or you're just nervous about quote unquote being wrong. Like, be wrong, get stopped out, move on. Law of large numbers, asymmetrical return on risk.
Yeah, I couldn't agree with that more. And again, like Ryan said this a few minutes ago, if there's one thing you take away from all this, this is it. So if you want to go back and listen to this after the show, please do, because that's, this is some very, very good information that will take you a long way in your trading journey that you're probably not going to find in these retail chat rooms on Discord or on Twitter gurus and things like that. They're not talking about asymmetrical risk. They're just trying to all get you to do their trades. So Ryan, let's talk about actually going ahead and setting up a trading strategy. Where do you start? How do you go about it? And does your strategy change depending on the market? Like, if we're in a bull market right now versus if, things aren't going well, or do you just stick to the basics no matter what?
Yeah, I think, setting up a strategy, God, there's, that could be millions of episodes just on their own, right? I mean, it depends what the trader themselves are comfortable with. So most retail traders have a trading strategy. You trade precious metals, you trade futures, you trade tech, and that's it. And you're a momentum trader, you're a position trader. You try to take the top weighted or highest performance. S&P or Q's components, whatever your strategy is, right? So you already have this. What you're talking about with risk management is managing the trades that you've decided to make. So step one, are you sure you want to make the trade? Like you have some sense of what you're hoping to achieve versus what you're hoping doesn't happen. And if it happens, you're going to take the loss and move on. No one should ever just let something crater, right? It just goes on and on and on. You're bleeding to death and you're sitting there going, it'll turn around. Please, I hope this will turn around. Like, don't trade if that's your outlook. You need to be fairly emotionless about these things. So when you go in, we use our $10 stock, right? You've decided you're a momentum trader. This thing has had whatever you consider a breakout. It's some pattern you learned. It's ticked some boxes on your indicators. Okay, so now you think it's going to go higher. So one, how high do you think this is going to go? Like, is this going to move all the way up? Is this going to, you're looking at your chart here, right? So you have like breakout patterns coming out of this chart that you're looking at. And, are you heading up towards a previous high? Earlier this year, you've established like an all-time high. So you have some reasonable expectation on a breakout that your previous high is possible. It's been there before. If it's never been there before, then what do? You take the average of the last 6 or 7 breakouts and you determine how far that's going to run. Then, like, where's your support level? Support and resistance are a whole other conversation. And there are multiple ways to calculate that, but you probably have some sense of like, okay, if it goes here, I totally didn't expect that and I'm wrong. So it's just a simple calculation. Realistically, and I always start with the negative, right? Like, this is where I'm going to stop out down here. So I set that. And then realistically, do I think there's potential for 3 times that? If the answer is no, I don't trade it. If it's fast moving, if I'm close to close, I might take 2 to 1. But that is absolutely the bare minimum ever. 3 to 1 is the average. 4 to 1 is ideal. 5 to 1. Honestly, I don't know how Dalio does it. Like, that's just lucky, right? It just kept running and you're like, ooh, I got 5 to 1. You could do it by adding options as well. And we'll talk about that in a little bit. So that's your first step with your strategy. Determine whether or not the run that you need to get relative to the risk you're comfortable with is likely to occur. If the answer is no, don't trade it.
That's very interesting. I've never really thought about it that way, honestly. Are there key elements? Are there any other key elements of a strategy that every single trader needs to think about? I mean, you mentioned stop losses that every trader should.
Stop loss. Like, it doesn't matter whether you are trading intraday. I hope you're not. But if you are, or if you're at least managing a trade intraday because it's run and now you're using like a trailing stop, you should always use a stop loss because it forces you to draw a line in the sand and you never touch it. So that's the other thing that a lot of retail traders will do is that, the stock collapses, it gets close to the stop loss. It's teasing it. It's almost there. It's almost there. It doesn't quite touch it. And you're like, come on, come on, come on. It has a couple of surges up. It goes back. It gets really close. And then it crosses the stop loss or threatens to, and the trader will grab the stop loss and pull it down to give it a little more breathing room. Like, oh, I've set it in the wrong place. If I just let it go a little further, it'll recover. No, it means that you didn't fully accept the loss when you put the trade on. You're violating the contract with yourself, which is, I'm out right here. At this point, I'm wrong. So you never touch a stop loss. It trips, you're done, move on to the next thing. Your profit target, you can absolutely trail a profit target, right? I mean, nobody's like, nope, that's as far as you go. That's what I analyzed. I'll take my money. No, like, if it's still rolling, you can use a dynamic trailing profit stop to try to capture a little more alpha. That's fine. But on the stop loss side, it's inviolable. That's the critical thing with risk management. None of us do that. There is no, I'm out at this level. Well, I looked at it. I changed my mind. That's how you get your face blown off by something like GameStop. Like, how many funds how many traders, because that was just insane. How many traders saw this? It blew through their stop loss, like on the short side. And they're like, no, this is ridiculous. I'm not going to do anything about it. I'm just going to, this will correct tomorrow. And then what happened the next day? It's like 200%, then it's 400%, and you're dead. Your broker's calling you and you've been murdered at that point. So like it hits that. The bottom line is you're wrong. Your analysis was wrong. Take the loss, move on. If it keeps happening, because you should review all of your losses as well as your wins, go back and look. And if you're slightly off all the time, like you would have been right, then work on, like, maybe your stop loss is way too panicky. It's just too tight. And you're too conservative in your run gain analysis. Oh, I think it's only going to be a couple points, so I can only afford this much on the downside. That won't help you either. You just stop out all the time. So you need to determine whether that's the case.
Yeah, and again, I mean, like setting the stop losses and things like that, I think are a lot of things that as retail traders we don't like to do, because a lot of us think like, oh, we're so great, I don't need a stop loss. Why? Like, and then you learn kind of over time the hard way why it's probably a good idea to have those in there. And
well, if you don't have it, you haven't done the math, right? The bottom line is if you haven't put that on, you've done no run gain analysis, you've done no risk analysis. That's your admission to yourself. Is there a stop loss there? No. Okay, you did no risk mitigation. So when you get blown up later, that's probably why. I should point out that we're really talking about equities trading here. We do not use stop losses for options because the spreads get really wide, especially at open. And you've seen them bubble up 5 minutes to the close, and you can easily get blown out accidentally on a stop loss by an eager broker and a blown out spread. So we don't use them for options. We set the point and we start to attempt to get out when that's tripped. So when you're, if you're looking at mid to ask or mid to bid and that threshold gets tripped, you can try to exit at that point. You're starting to work your exit. But we don't use just a hard stop loss for the reason I just mentioned for options.
Yeah, and I've actually had that before on my options trades where I've had like a stop loss in on there and I'll get stopped out and then I'll look at it like 2 seconds later and the option value is way back up like 2 minutes before where I like way above my stop rate. I'm like, why did I just get stopped out on that?
I mean, you have like, a tighter spread. It's like, 360 by 380. And then, 5 minutes into the close, that blows out to 360 by 750. Like that's not real. And you'll get some broker that's like, well, yeah, it's in there somewhere. Cool. Buy, boom. And you get blown up. And it's like, okay, that's, so we don't use them for that. We just mark the number and keep an eye on it, set alerts.
Okay, so Ryan, how do you go about increasing and maximizing your asymmetry when it comes to having these trades?
If you do your basic analysis, and this is going to require a little more math on your part. It's something that if we do like a second educational series and we do like a little more advanced stuff, we can get into the calculations, how you would want to do this. But if you've done, so let's say you do your run gain analysis and you set this is an acceptable threshold. That's where I think support exists. And stop losses, by the way, are always below support, not above support, not in the middle of support, always below support. So whatever your support range is, the stop loss is under that. Otherwise you're going to get taken out prematurely. So you've set this up and you still feel like this is a really good trade. Like all of the signals are there. It's not a cowboy stock. You've done your analysis and you are positive that this is going to work, but you can't get this to be better than like, let's say 1.5 to 1, like, or 1.2 to 1. Like it's about even risk versus reward, but you think that the probability of success outweighs the lack of substantial asymmetrical return on risk. You want to do this anyway. Okay, so what can you do to skew the asymmetrical return on risk in your favor? This is what we do. We use long options in the opposite direction and a limited number. So I'm buying my $10 stock. And the $10 stock is for sure 100% guaranteed going to make it to 1150. Like I know it's going to do it. Look at it. Everything is pointing. I got nothing but green lights across the board everywhere I look. All my analysis. But support's $9 and it's pretty established support. Like there's not a lot between 9 and 10. So if this makes a run at 1150 and fails, it's probably going to fail all the way down to 9. So I got to put my stop loss there. My asymmetrical return on risk sort of sucks. So I want to trade this, but I don't want to accept this. So what I can do is I can buy a limited number of below the market put options, which will increase in value as the stock collapses, right? So as the stock is collapsing, I'm not losing exactly dollar for dollar. Like I'm not losing the whole dollar between 10 and 9. I'm losing part of that dollar, right? Because the put options are now going to make me a little bit of money. I don't recommend using at the money options for that. You would want to use the next strike out of the money. And depending on the volatility of the stock and the proximity to expiration, so how much gamma is going to impact this, you're gonna pay. You could pick further out of the money if that makes sense. You can do a calculation. I mean, we're talking about here like generally swing trading. Position trading, you wouldn't do this because it's going to eat way too much in terms of theta. Like you're not buying quarterly options and leaving them on for 60 days. Your premium's just going to get eaten by theta. So that's not a good way to do it. For swing trading, you buy a limited number of put options, or if you're shorting something, a limited number of call options. And then your exit is a net of $1, which will let you go lower than the $9 mark. You're not buying the options one-to-one or more options than you have stock. So it's not going to get better and better and better as it collapses. It's basically going to offset some of the loss. So by doing that, you're going to be able to turn something that's 1.5 to 1 into like 3 to 1 or 4 to 1. So that's a trick that it's not a trick. That's how the business works. So we will use a limited number of inversely correlated options on the long side in order to offset that crappy asymmetrical return on risk.
Beautiful. I like that a lot. I might have to start implementing some of that myself, Ryan, and let you know how it goes. We kind of touched on this earlier. We mentioned Renaissance being just above a 50% win rate, but how often, if you are, properly, kind of getting more back from your winners than you are losing on your losers, how often can you make the wrong trade, and how often do you need to be right in order to be profitable?
So there are two things required for an edge to be valid, in my opinion, right? So an edge is simply a trading strategy that is repeatable and profitable. And that is, one, you need a better than 50-50 chance of A happening instead of B, so a win versus a loss. And you need an asymmetrical return on risk that is usually present. So some derivatives, some ETFs, some gap ETNs gap reliably over and over again in the same direction, but when they fail, they gap like 3 or 4 times the wrong direction. So that's an example of something that has like built-in winners, but the losers just whip your ass and you have no idea when those things are coming. So there's no actual edge there. It seems like there is, but there isn't. But to answer your question, like, you really do not need to win more than 50-50 if you make sure you trade 2 to 1 or better. Think about it. You got $10, right? And you got 10 bets, $1 a bet. 5 of those bets, you're going to lose $5. The other 5, you're going to win $2. So at the end of the day, you're net plus 5. Like, that's it. You could have a worse return on risk than that, or you could win less 4 out of 10 times and still make money. And that's why it seems nuts that you can be right like 22% of the time and paying off your Ferrari, but that is absolutely the truth if you have a strategy, are disciplined enough, and edge that can return something like 5 to 1. I don't have that. So me, 3-1, 4-1, something like that is what we aim for. And we manipulate it using options whenever possible. Frequency helps. Again, like I'm not a big proponent of like frantic trading, like I have to trade every day and massive random turnover. Like, trade as much as makes sense given your strategy. But that's the biggest takeaway is you don't feel like you have to be right like 8 out of 10 times. You do not have to be. And if you try to do that, you'll spend a lot of your time very unhappy and dissatisfied with your performance needlessly, because the rest of us are not right 8 out of 10 times. We just make more money when we win, and we don't lose a lot when we lose. That's the key.
Interesting. We also discussed earlier kind of how important it is to be able to take emotions out of trading while you're doing this. How does having an actual strategy help when things might get a little, if emotions are running hot or you're feeling very frantic, or maybe on the other side, you're feeling very, oh, this is awesome. I just hit 10 trades in a row. I'm on top of the world. How can having a strategy help in these situations?
Yeah, I mean, it forces you to have a cold, hard look at the decision you're about to make, right? I mean, that's the bottom line, is that if you don't have these rules, if you don't do a risk analysis, if you kind of eyeball it, then you can make these emotion-filled trades. I'm feeling good about this, been good to me. Like, I mean, we've joked before. Like there was a year when I wanted to send Apple a gift basket, right? I mean, like I was just right every single time. It was paying for tons of stuff for me. I felt fantastic. But, that's a random distribution of wins and losses. And I was on the right end of that particular year. Now posted permanently in our trader Slack chat. Well, not permanently, just nobody's taken that down. It says, yes, Apple is still on my shit list. Like, I don't know when that got put up, probably 3 years ago. But, you have these ebbs and flows of being right and wrong. And having a system in place forces you to confront the decision. You do this run gain analysis and it's not good. You have to do it anyway, knowing that it's bad. And usually I find that's enough to stop most retail traders, most traders, period, from making a bad decision. You see the outcome. It's like, okay, if I'm going to keep doing this, I got to be right 83% of the time. You're not right 83% of the time. So you may take your finger off the trigger and you may step back. So that really helps with the emotionless trading. That small lot size and the largest distribution across all of your candidates is part of the basics of a systematic trading strategy, right? It's like, look, I don't care if I'm right all the time. I don't need to be, because I only fire things off that are 3-1. My lot sizes are small, so when I do take a hit, it's not very painful for me. It's a small hit. When I take a win, it's not a huge win either, so I don't get euphoric and get that like I can't be harmed sort of false sense of confidence. And then I distribute these across as many candidates as I can find and I'm comfortable with, and I let the law of large numbers work for me. So if you have 4, 5, 6 losses in a row in that situation, you don't take them like you do when it's all on gut and emotion, because you're like, yeah, I'm supposed to have 4, 5, 6 losses in a row. That is baked into this strategy. I guess I got them this week. And you could just go on with your day and spend time with your friends and family or whatever it is, and not be brooding about, oh, I suck. Why can't I get this? Everyone's smarter than me. They're not. And this system will absolutely flip in your favor so long as you validated that you have the edge that you think you have. So that's where it comes into play the most.
Yeah, and I mean, I think, I've had it both ways, where my emotions have been running hot because I've been losing and I don't know what's going on, and I'm, oh my God, and I've had it where, oh my God, this I'm so euphoric because I just made, so much money, and then I traded all away the very next day because I think I'm on top of the world and I'm going to be the next, Renaissance guy, Jim Simons, that's going to make, so I think being able to implement a strategy would definitely behoove myself, and probably a lot of people listening, if I had to guess, Ryan. Um, How has your elements of your strategy changed as the chief investment officer over at Kaiju versus when you were in my shoes as just a lowly retail trader?
Well, yeah, I wouldn't use the term lowly retail trader. I mean, obviously, risk management is just a different game at an institutional level, right? I mean, we have an enormous number of tools that are just geared to risk management. The options guys here, the Volarb guys, they use 3 or 4 separate tools to, calculate surface model integrity and deal with projections and like look at term structure, and they do a lot of math to determine whether or not this is going to work out, how it fits into a very complex portfolio holistically. Like, if this goes down, what's it likely taking with it? Do I have systemic risk in this portfolio? Like, is everything tech? So I could be, I've applied my strategy perfectly. I've done my risk assessment. I've allocated small. I've allocated across a large number of candidates, but I haven't paid any attention to my concentration. And so I happen to be all accidentally in semiconductor or semiconductor exposed stocks. And then there's production fears, the semis tank, and my whole portfolio goes with it. And I have no inversely correlated assets to offset that. Okay, so that's what it is at an institutional level. I mean, like, my Bloomberg is not actually set up to trade stocks at all. It's to identify portfolio systemic and holistic risk within a portfolio, right? So, that's simply the difference between the two. When you're starting out, you're really looking at risk from a discrete trade perspective. That trade, NVIDIA today, this run, I think it's going to go here by the end of the week, this thing, and then the next one, and the next one, and the next one. And as you become more sophisticated, you're going to start stepping back and start looking at these collectively. Like, if you've just traded NVIDIA, do you need to trade AMD as well? You may have seen exactly the same pattern in that. Yeah, they're both semis, so, or semi exposed. So pick one. Don't trade both of them. You're getting the same price action probably between the two if they're lining up identically because they're responding to the same stimulus. Then pull up SMH. Like, look at that. If you're really into semis, is that have the same setup? Now you have broad exposure to the sector. So maybe pick that instead. You start to ask these types of questions, and then, consider inverse correlated opportunities, right? If you're wrong, I mean, all the index ETFs have, inverse opportunities. You got the small Qs, right? Like, you could take, the SQs. You could, and if you're concerned about a tech collapse, it's a quick one-stop go-to shop, right? And you don't have to short it. You can buy it long, and it'll start ticking up while everything else ticks down. So, you look at it from that perspective more than you would when you're just starting and you're like, I'm trading gold or I'm trading whatever it is.
Yeah, and again, guys, I mean, what we've been discussing today is all about how to mitigate your risks in the sense that you can still set yourself up to have a winning strategy, to making money over time in the market without necessarily putting everything at risk. In fact, you're not going to have a winning strategy if you don't manage your risks properly. So if anything, at any point, you want to go back and listen to what we discussed today, you will be able to just rewind once this video is posted to YouTube. Ryan, we've discussed so many things today. We've had a great conversation, running a little bit long on time, but let's get to our Kaiju kicker, our big takeaways of the day. Let me go ahead and pop this up on the screen, and then how about you walk me through them real quick?
I was going to plug my ears. I thought it was going through that like rock video bumper thing again. It's like, that's always deafening. Okay. No, we got it, just a slide. It's perfect. Okay. So I didn't come up with plan the trade and trade the plan. That was something that was said when I started trading like all the time. A pro equities trader that I worked with in the beginning had that actually taped above his computer monitor. I do not know where it came from, but everybody says that, and it's not wrong. So title of the slide, let's go with that. Never alter your fundamental trading plan after you've agreed to it with yourself, right? So it doesn't matter what you've decided to do, position, swing, momentum, even intraday, please don't do it, but even if you're intraday, have a contract with yourself. This is the outcome. Here's where I'm out. That's right. This is wrong. If you're right, you can be more right. That's fine. You can alter that part. Or I wouldn't say alter, but you can adjust to eke more profit out of it. When you're wrong, you're just wrong. Move on. Never trade anything that's not at least a 2-to-1 asymmetrical return on risk. Try for 3-to-1 or higher. And that will just work with you not having to have an unrealistic win rate in order to make money. Do consider small numbers of long options to change the risk ratio of a trade without altering the trade plan. So again, you're pretty sure this is a good trade and it's a solid plan, but you can't get the numbers to work the way that you'd like to. Model some long options in either direction, depending on if you're long or short, to skew that return on risk to something that is more like 3-to-1. And then remember, it's your net. So in your trading software, if it's TWS or whatever, you're going to combine those positions. So you're seeing the net outcome when the net outcome is the -1 of the 3-to-1. You're done option and equity. Do not let your hedge run. That's something I wanted to add that's important. So if the stock is still collapsing and that put option is kicking out more and more and more money, do not let it run. It's so tempting. It's like, well, now I got a winner on this side. You never did any analysis on that trade. That's not a primary trade. You only ever accepted that as a hedge. So when it's met its use, unload it and move on. And then always use a good till cancel stop loss or a trailing good till cancel stop loss for a tighter intraday exit. Always, always, always. Not day only. You're gonna forget to set it the next day.
I've run into that. I've run into that problem before. I've set a stop loss that expires at the end of the day, and then the next day, it's like down this much. I'm like, wait, I thought I had a stop loss on this. What
every
happened?
Stop loss is GTC. You do not use day orders for stop loss.
Remember that GTC.
GTC, good till canceled. Always use one. Follow that, and you should be in better shape than I'd say 95% of retail traders.
Yeah, that's like I don't know. I was gonna make a joke about people getting canceled. Someone's good GTC, they're good till canceled. All right, well, Ryan, this is again has just been great information today. Cannot stress enough to the audience out there listening. Really, in terms of everything we've discussed so far, what can help take your trading to the next level? What can help set you up to having a winning strategy? Because if you're just going out there willy-nilly, trading what you like, trading what you see people talking about on Twitter and Discord, you might have a good day. You might have a good week. You might even have a good month, but chances are you're not going to be able to sustain that over time without some of this risk mitigation strategy that we've discussed today. And really, again, it all boils down to, are you winning more on your winning trades than you are losing on your losing trades? Because you could not bank on having over a 60% win rate or whatever you would need to have if everything was 50-50. If you lost all the exact same amount that you won on every trade, then you would need to have a win rate that is essentially impossible to maintain. So this is the way to do it. And it's honestly, like you said, Ryan, it's not as sexy as saying, hey, 9 out of my 10 picks are correct. Hey, every single time I place an options trade, it's right. Hey, buy my picks. No, it's not that sexy. Instead, I'm very meticulous. I'm diligent about mitigating risk, about making sure I'm winning more than I'm losing on my trades. And then if you do that, then, over time, you should be okay.
The wealthiest managers on the planet do not have, by and large, a better win rate than 6 out of 10. Just let that sink in, accept it. If you're like, well, my average is 90%. Yeah, this week, this month, right now, whatever. But over time, it won't. I've spent part of my career with an 83% win rate. Enough to be quoted as having that. It didn't last. Favorable market condition, you could totally do that. But over time, overall, it's this that's going to make you the money and not the win rate.
Got it. Well, Ryan, again, thank you so much for hopping on Benzinga Live today.
Always a pleasure, Aaron. Always a pleasure.
We will be back next week. So make sure to tune in because I don't know. I mean, I guess we got to discuss the scheduling because
I
next week
think we're doing order entry. Are we doing actually order placement and order management next week?
I
I
believe
don't
so, but I was saying so next week you guys want to tune in because we'll probably the next week I assume be off during the week of Christmas, or at least I'm not sure where I'm gonna be, but next week again, make sure to tune in. We'll be discussing. We'll be taking again. We're taking little baby steps here. We're getting you. We're now at the point where we've talked about how to set up your brokerage account, what indicators to use, how to mitigate your risks, and then again next week we will be talking about orders and how to again just take that next step. So by the end of this course, I mean you guys should be able to I'm not saying that you're all going to be trading like professional traders, but you'll have all the information to allow you to make more informed trades, to allow you to make more informed decisions. And it's like anything else. The more you do it, the more you'll learn. You'll probably screw up a little bit, and then you'll learn from those mistakes, and then you'll go, oh yeah, okay, that's why Ryan said that, that's why Ryan said to put that stop loss, and oh yeah, now I remember. And then eventually we'll all be making money in the market, right, Ryan?
Let's hope so. That's the goal, right?
That is the goal. Well, again, thank you again for hopping on. We will be talking about we're just talking about all order types next week. Do not want to miss that. Same time, same place, 11 a.m. Eastern on Tuesday here on Benzinga's channel. Ryan, thank you again. I'm going to drop the links in the chat to Kaiju dip ETFs if you guys want to learn more about what Ryan's working on over when Ryan's actually working and when he's not giving us his precious time here on the show.
Sounds good. Slaving away.
There you
Making
go.
AI magic. That's it. That's it.
All right, Ryan. We'll take care. We'll speak next week.
Cheers. Thanks, Aaron.
All right, guys. That was Ryan Pannell, the CEO of Kaiju. Again, DIP ETF, ticker DIP. If you want to check out their ETF that they're managing with AI technologies and doing some really cool things. Again, Ryan's just been a pleasure to have on every week, sharing this information. I don't know. A lot of this stuff that Ryan and I've discussed, I've like heard before and learned before, but like hearing it from Ryan, it's like a good reminder. Like, oh yeah, that's why I gotta have those stop losses, and that's why I gotta make sure I'm not losing all my money on these losing trades, and I gotta let the winners run and all these things. So, why not saying this course is a 5-to-1 win rate? Yeah, that's that Dalio ratio, baby. We're going for that Dalio ratio. But alrighty, guys, running a little bit over time here. It's a minute past noon. Make sure to stay tuned. The stream will redirect you to the rest of the content we have going on today. We'll be back later this afternoon, of course, with some more great content. And then we will be back tomorrow, pre-market prep, 8 a.m. Eastern, as always. Till then, stay green. Happy trading. Peace and love, Zinger Nation.